I must say I'm in my old age reaching a point where I have a little trouble convincing myself that the stock market is that important and that we live in an age where some much more important issues are playing out. But I view the stock market now really as a hobby. And the one thing that I have kept going is resources and climate change related investing, and also, for old time's sake, investment bubbles, since I've been doing that for 40 or 50 years. And since I find myself unexpectedly in the third great investment bubble of my career, basically in the US. So I can't avoid it. And this is a wonderful day to be having this discussion. It's not only Victory over Hitler in Russia Day, but it's also a day where the market is showing signs of breaking down. Through yesterday, it's the worst opening of a year for the S&P since I was 1 year old in 1939. I am a pre-war baby. And of course, the NASDAQ is down as we speak, 27.5% from its high, and the Russell 2000 about 23, S&P about 15.5. So it's getting to be interesting. And as we were saying before, Bitcoin from some point in the last 24 hours is down 10% to 32,000 and change. So that is getting interesting. And ARK, Kathy Wood's wonderful instrument, is back to it where it was in 2018. I'm not kidding you. It is back below this entire event now, which is quite remarkable, down 75% from its peak, as is AMC, down 75% from its peak. And the other meme stocks are in ragged disarray. So this is the real McCoy, seems to be playing out pretty close to 2000. Always considered myself a fairly serious amateur historian. And what I've done in bubble territory is I don't try and build models to explain every day. I focus on the four great bubbles, which are characterized by nearly hysterical behavior, really seriously weird over-optimism, which is very rare, which are characterized by accelerated price moves on the upside and by a weird deviation on the upside between the blue chips going up and the risky stocks going down. And that is rare as hen's teeth. It happened brilliantly in 29. It happened during the year 2000, again in spades, with the S&P X growth continuing to go up through September of 2000. And the growth stocks basically going down 50% and the internet stocks dropping maybe 60, 70% by then. So that was spectacular. And we saw a very handsome deviation between the S&P rising last year and the Russell 2, for example, dropping quite handsomely. So there was a 20, 25 point spread on the upside. And that for me is a pretty good indicator. And I'll tell you what it describes. It describes Mr. Prince's "I've got to keep dancing because the music's still playing." And we understand that completely, the enormous commercial imperative of the industry to play up to and over the edge. But they're not complete idiots. And so they say, well, I've got to keep dancing, but I don't have to keep dancing with Pumatech, the most advanced stock in 99. I'm going to transfer to Coca-Cola. And I'll keep dancing off the edge, but I'll go off with Coca-Cola. And it works. The Coca-Colas may be handsomely overpriced, but in 1929 and 2000, 2001, and so on, they always go down a lot less as the bubble breaks. And that's the phenomenon that causes this very rare indicator of impending doom, which we saw last year. And so by early this year, it seemed clear to me that this was not only the real McCoy bubble, which had been clear for a year or so in terms of pricing and enthusiasm, but it had triggered this very rare indicator of impending doom, in other words, now. And so our piece of a year and a bit ago was called Waiting for the Last Dance. And our equivalent follow-up this January was Let the Wild Rumpus Begin, i.e. we're in it, dudes. And I do believe we are. And I believe the declines will be very substantial. We have a market today which feels superficially like 2000. And I think it's going to play out initially like 2000. And then, unfortunately, it's going to phase, as he suggests, into the 70s, where the deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today. A word on inflation, too, I would summarize as monetary and general Federal Reserve overstimulus for 30, 35 years. The war and COVID, all of those three influences guaranteeing that we have a relatively intractable problem in the short to intermediate term. What worries me is the longer term arguments for inflation, which is one, we are running out of people. In China, where the 500 million extra farmers precipitated globalization, they have now had diminishing cohorts of 20-year-olds for 20 years. And they are guaranteed, since they're alive now, we know the baby cohorts are dropping like a stone. They are simply going to have a shortage of labor, as is the developed world together. That is not a trivial block, the developed world plus China. All of them will be squeezed for labor. After the bubonic plague, they had a 100-year honeymoon period in which wages went up so much it wasn't reached for another several hundred years in the Industrial Revolution. And we are entering a period where labor is simply scarce, which feels to me inflationary. And at the same time, we have a scarcity beginning in resources. And we keep an original, unusual index. It's 36 equal weighted the most important commodities. So it's not dominated by oil. And it showed a declining pattern for 102 years, from 1900 to 2002. And yes, it was interrupted by World War I and World War II and OPEC. Why wouldn't it be? But it wanted to go down. It went down 70%. It took the index down to 30. Today, 122 years later, the index is down 10%. It has gone to 90. The average important commodity has just spent the last 20 years going from 30 to 90. It has tripled. The reason is, of course, the growth of China, but I believe, fairly passionately looking at the data, that it also represents the intrinsic scarcity, the war between deeper wells, worse iron ore, etc. The best go first. The struggle is always between technology, which for 100 years got ahead of scarcity. It was 2 paces down for deeper and 3.5 paces up for technology. And now we've reached a phase where we've gone through that stuff. And now we have 2 paces up for technology and 3 paces down for scarcity. The data is screaming at us now for 20 years that we're beginning to run out. And a war, of course, and COVID, we're so fragile. All you have to do is cough now, and it ricochets around the world in price spikes and shortages and bottlenecks. And that is the world we better get used to living in. We're going to have a world of increasing number of bottlenecks and shortages. And the same applies to food. The UN Food Index is higher today than any time in its history of the last 50 years.